Funny how there's no page numbers. Funny. Wait, duh. Do I even need to read the summary? Dang it. Why is it so long? 37 pages? Come on. Also, why do they put an appendix in the middle of the chapter? It doesn't make any sense. Dang it. Come on. Why are we even covering Chapter 7 anyways? Why are we going all the way to Chapter 7? Randomly. Out of nowhere, we're just doing Chapter 7 first? And then Chapter 4? Why are we going all out of order? Should really keep that schedule just like over here so I can easily get to it, because that's kind of important. Oh. It's something I refer to often because of stuff we're doing in class. Because according to this schedule, today is the 18th. In class, for the whole week, we're going to be covering Chapter 7. What? Why Chapter 7? Why do we skip Chapter 2 we skipped Chapter 3 for no reason, and then we skipped Chapter 5 and 6 for no reason? Oh, and then after Chapter 7. So when are we going to do Chapter 5? This schedule doesn't even show Chapter 5 here. What? One of our assignments involves Chapter 5, doesn't it? No? No, it's 7, 4, 4, 8, 7, 7, 4. We literally don't even cover Chapter 5 or 6. Or 3. We're skipping tons of stuff. Okay, then. Anyways, I guess I should read the chapter. Like this, I mean, if reading this whole chapter will prepare me for the entire week, so I guess that's fine. Although I don't really have to read the whole thing, do I? But of course there's an assignment that covers the whole chapter right there. Dang it. I mean, it shouldn't even take that long anyways. You know what, I'm gonna skip this stuff. indicate how to report cash and cash-related items. So money orders, certified checks, cashier's checks, personal checks, and bank drafts. Also viewed as cash. Savings accounts. Wow. Well, the entire point of entering music is to go into more detail of stuff we did. Financial accounting. And then we spent the entire week mostly just doing stuff that we did in financial accounting. Cash equivalent. Cash and cash equivalents. Cash equivalents are short-term, highly liquid investments, readily convertible to known amounts of cash, so near their maturity that they present insignificant risk of changes in value because of changes in interest rates. Wow. This is taking 5 billion years. This is gonna... This is taking 5 years. Well, I guess this is a nice summary. Cash is classified as cash. If it's unrestricted, it's reported as cash. If the cash is restricted, you identify and classify it as current and non-current asset. Petty cash and change. Cash. What? That's the only comment? You gotta be kidding me. Short-term paper. What does that even mean? What does short-term paper mean? Classify it as a cash equivalent. Investments Oh, so the comment is describing what it is, right? Short-term paper. Investments with maturity of less than 3 months, often combined with cash. Short-term paper. Temporary investment. Investment with maturity of 3 to 12 months. Post-dated checks and IOUs. I don't even know what that means. A receivable. So it's just receivables. I don't know. Assumed to be collectible. Travel advances. Receivables. Assumed to be collected from employees or deducted from their salaries. Postage on hand as stamps or in postage meters. Prepaid expenses. May also be classified as office supplies inventory. What? Are you kidding me? How does that make any sense? Bank overdraft? Current liability. Some random exception. They say if right of offset exists, reduce cash. Compensating balances. Cash separately classified as a deposit, maintained as compensating balance. Classify as current or non-current in the balance sheet. Disclose separately in notes details of the approach. That was funny. How is that the first 6 pages of the chapter and there's still like 25 pages, no, 30 pages left? Random other issue. Receivables, learning objective 2, define receivables. That was sniffy. Ow. 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 Define receivables. Hold up. Hold up. Why is this in the same chapter? Okay, why is this... Never mind, I'm an idiot. I thought the chapter was only about cash, but it turns out it's about cash and receivables. That was fine. That was fine. You made a noise. So anyways, if we already finished the section about cash, then what? Is the receivable section going to be like 1,000,000 pages long? Yes. That is in fact accurate. Are you serious? The cash section is like the first 5 out of 35 pages, so that's 1/7. There's only 1/7 of the chapter is about cash. The rest of the chapter is about receivables. That figures. I thought I was already halfway done, but no, I'm not. In terms of the title, I'm halfway done. In terms of the page number, I'm only 1/7 of the way done. Oh, man. A loan. Wells Fargo provides funds to Tesla. Tesla owes GoPro recording an account receivable when it sells a camera on account to one of its retailers. GoPro cameras for purposes of discussion. They reduced the wording on that to just, for purposes of this discussion, we will simply use the term receivables to mean loans and receivables. For financial statement purposes. Why am I reading this whole thing out loud? When can I eat those brownies? Oh my good. That was great. It's funny how my car ran out of, or the air conditioning stopped working in my car the instant I started driving to school every day. Ooh, that's fun. And you know what's great? I don't know if I'm even going to be able to... It depends on how much money it costs for me to add another vehicle to my parking permit. It cost me like $100 to get a parking permit. So is it going to be $100 per car, or is it not going to be very much to register another car? Please tell me it's not going to be that much. Because otherwise I'm going to have to drive to school without air conditioning. And of course it's still extremely hot out. Great, thanks. You could get cool outside so I don't have to worry about it as much. No. Of course it's going to be like in the 80s or 90s this whole week. Good job. Even though it's the end of summer. We're still technically in summer, so that's why. Dang it. Stop. For financial purposes. Statement purposes, companies classify receivables as either current or non-current. Current receivables within a year or current operating cycle. All other receivables are non-current. Receivables can be further classified as either trade or non-trade receivables. Dang it, what is that? Customers often owe company amounts for goods bought or services rendered. Company may subclassify these trade receivables. So... Wait, there's even more subclassification. Are you kidding me? Oh, jeez. So there's multiple types of trade receivables. There are accounts receivable and notes receivable. Oh wait, I'm stupid. I already knew that. I thought it was more complicated than it really was, but no, I already knew that. Accounts receivable are oral promises of the purchaser to pay for goods and services sold. Notes receivable are written promises to pay a certain sum of money on a specified future date. Alright, well. Non-trade receivables. There's a variety of different non-trade receivables. You gotta be kidding me. Advances to officers and employees. Advances to subsidiaries. Deposits paid to cover potential damages or losses, deposits paid as a guarantee of performance or payment, dividends, and interest receivable. Claims against insurance companies for casualty sustained, claims against defendants under suit, claims against governmental bodies for tax refunds, claims against common carriers for damage or lost goods, claims against creditors for return damage or lost goods, claims against customers for returnable items. Because of the peculiar nature of non-trade receivables, companies generally report them as separate items in the balance sheet. Well, here, simple stuff. No, it's not. Current assets. Cash and cash equivalents. Accounts and notes receivable are in the same thing. What? What? Trade receivable. Current notes Dude, what? The way they report that is so weird. Dude, that doesn't make any sense. I'm confused. Wait. Shouldn't they put accounts? Shouldn't they put accounts and notes receivable as the heading for the whole section, and then these two, and then this line is a point, and this line is a point? That doesn't work. Come on. We'll try this one. Cash, short-term investments, receivables, trade due from foreign affiliates, other receivables. There are trade receivables due from foreign affiliates and other receivables. So there. Allowance for doubtful accounts, subtract net receivables. That was great. The basic issues are the same. Recognition, valuation, and disposition. Oh, come on. Where's that? This is taking 5 years to get through this, and I can barely understand anything. Lululemon. Is that how you pronounce it? Lululemon. I see the word lemon and I just think I see Lulu and lemon, so that's how I say that, but I have no idea if that's how it's pronounced. If that thing sells a yoga outfit to Jennifer Berian for $100 on account, when does they do recognize revenue and the related accounts receivable? They will recognize revenue when it satisfies its performance obligation by transferring the good or service to the customer. Then it's transferred when Jennifer obtains control of this outfit. Then it will recognize an account receivable and sales revenue. So, debit accounts receivable. That means you are increasing the asset of accounts receivable by 100. And credit sales revenue, which means you earned $100 of sales revenue. Good job. You can't even, you're struggling to grasp basic concepts in accounting. The concept of change of control is the deciding factor. Man, why do I have to say that word so many times? Oh, I need to just look up how to pronounce it. Just tell me how to pronounce the name, dang it. Was I saying it right?
Lululemon.
I was saying it right. Yeah, okay. But it's just such a weird. Lululemon has the right to pay from the customer. Lululemon has passed legal title to the customer. Lululemon has transferred physical possession of the goods. Lululemon no longer has significant risks and rewards of ownership of the goods. Jennifer has accepted the asset measurement of the transaction price. Oh no, variable consideration. Oh no. In some cases, the price of a good or service is dependent on future events. Discounts, returns and allowances, rebates, and performance bonuses. Here are 4 items that affect the transaction price, and thus the accounts receivable balance: trade discounts, cash discounts, sales returns and allowances, and time value of money. Well, I've already kind of learned about the stuff in financial accounting, so it's not something new to me right now. It's just the way they're wording it is making me scared. Wait, what? Oh, Sniffy. What was the other team that he had as a bad team because of their quarterback situation? I can't remember. What happened? Like the Cowboys lost their starting quarterback, so he put them at the bottom of the list. What was the other team? They lost their starting quarterback. Can't remember. Trade discount. Trade or quantity discount. They really just said that your cell phone has a list price of $90? How old is this textbook? It's not even an old textbook. Are you kidding me? When on earth can you possibly buy a cell phone for $90? When? I literally just paid $270 for a budget phone. Are you serious? Oh, jeez. Wait. Yep, I remember that. That was from 2 years ago. 2% if paid within 10 days, gross amount due in 30 days. What on earth? 2% if paid anytime by the 10th day of the following month, with full payment due by the 30th of the following month. Hanley Company sells goods for $10,000 to Murdoch Incorporated. Fail. With terms 2/10 net 30. Hanley expects that the discount will be taken. Hanley records the accounts receivable and related sales revenue at its net price of $9,800, which is $10,000 minus the 2%. Okay, so this approach is often referred to as the net method, as it attempts to value the receivable at its realizable value. If it fails to take the discount, debits the discount not taken to accounts receivable and credits the sales discounted forfeited. What? That doesn't make grammatical sense. Yes, sales discounts forfeited. I think that's a mistake. Anyways. It's a terrible idea to do homework at the same time as a Sunday, which is when literally every single NFL game happens except for 2 of the week. They all happen on the same day almost. Sales discounts forfeited. Yes, look! They literally said it again in the next word. Fail. Is shown in the other revenues and gains section of the income statement. Yeah. Oh, wow. Okay. Theoretically, the net method is correct because the receivable stayed at realizable value, assuming estimates are correct, and the net sales measures the revenue recognized from the sale. However, many companies continue to use what is referred to as the gross method. Dude, I hate English. I hate the English language. Why does the word gross have to mean that? 2 different things. You've got to be kidding. The gross method. I am displaying my immaturity. Records the account receivable at $10,000 and then recognizes sales discounts when it receives payment within the discount period. Deduction from sales to arrive at net sales. Okay, we will look at this table to see what happens here. Hello? This is confusing. You should put like a line through the middle to make it less confusing. But anyways, accounts receivable, sales revenue, payments on 4,000. What? What on earth? They're saying that they're describing something that they did not describe at all, which is that the customer's giving two separate payments. Okay, so then they paid $4,000, so they received a discount on that amount. They received a 2% discount. Therefore, they paid $4,000. No, what? No, they paid $3,920. Wait, I'm so confused. Didn't they pay $3,920? Yes. Okay, here's what happened. The customer paid $3,920 because they got some discount. So they paid that much, but it actually counted for $4,000. So therefore, sales discounts is an account. I forgot what it is. A sales discount is something that it gets subtracted from sales revenue. It's debit. The debit subtracts it. Oh my gosh, why is my brain not comprehending this information? Okay. Oh, jeez. Okay, this is the gross method. The gross method is the method we used in the financial accounting class. I remember that. That's what we did in financial accounting. Because we did sales discounts, blah, blah, blah. We did not use sales discounts forfeited. Oh, my goodness. Cash accounts receivable. Payment of $6,000. After the discount period, so it's $6,000. I'm not gonna study it anymore. Oh my gosh. They say that the gross method is a little bit more practical. Anyways, sales, returns, and allowances. Hey, guess what? We finished a section there for it. Okay, this is stupid. This is terrible to do homework on this same day. It's not that it's terrible. It's that I'm terrible. Nothing new has occurred. Nothing new or interesting has occurred in the few minutes that. Anyways. Another form of variable consideration, which is sales returns. Max Glass sells hurricane glass to Oliver Builders. Max includes a provision that if Oliver is dissatisfied with the product, Max will grant an allowance on the sales price or agree to take the product back. So sold the hurricane glass. So there you go, it's free. Then grants an allowance of $300. Wait, what? What? How does that work? That sounds like a terrible deal. unless I'm not reading this correctly. They only got $300 back for the defective glass, even though they paid $5,000. That sounds terrible. Yes, contra revenue account. That's the word I was looking for earlier. It's a contra revenue account because it decreases the revenue. There. What? What on earth? Allowance for sales returns and allowances. What? That's a contra asset account. Offsets accounts receivable on the balance sheet. So this one, they directly decrease. Wait. Yes, they directly decreased accounts receivable. In this one, they indirectly decreased it by crediting an account that decreases that. Oh my gosh, so complicated. Like, why is this the first time I'm getting confused? In every single accounting class I've taken, never mind. The financial statement analysis class was extremely hard, but it was mostly because the textbook was worse. Or I don't know. It was, we didn't have, no, stop. I guess it's the only reason they did that differently is because it's an estimate instead of actual. That was funny. Don't credit that because you don't know precisely the amount that will be subject to the allowance. Max reports net sales revenue. High value of money. Can we please get through? We're 11 pages in already. Not already, but taking 5 years to get through 11 pages. It took me almost a whole hour to get this far. How? Why am I struggling to read through this chapter right now? Um. Well, wait. What? How great that your illustration was that you literally said you multiply it by 0.96154 when I have no idea why you're doing that. Okay, don't be alarmed. I took a corporate finance class, but I forgot everything, so too bad. 12% annual interest. Oh. So short-term receivables, let's just ignore present value concepts. We have finished an entire learning objective. How about I look at it after? That was all hilarious and awesome. think I know what's happening. They're going to like a Bible study or something. That's why they're like getting ready to leave. Nothing new has happened here. The Texans Broncos. Oh my gosh, what is going on with the Broncos? I just realized they're supposed to be like a really good team, and you're failing against the Texans. How? The heck? What is going on here? I mean, the Texans aren't doing very well either. They're just scoring a bunch of field goals. That's all they've been doing this whole game. What is up? Okay, now, I don't know. Can I read some more stuff here? We're still so far from finishing the chapter. We finished 2 learning objectives. Maybe I should just keep the schedule open just to be... Because, like, we have learning objectives... 4. There are 4 learning objectives. So technically I'm halfway through the learning objectives by now. But I'm not even close to halfway done with the chapter itself. It'd be nice if I could just study 2 learning objectives, but no, because we have we have an assignment that covers the entire chapter. Right here. This is an entire chapter long assignment here. So explain accounting issues related to valuation of accounts receivable. What did I just read about? I read about recognition of accounts receivable. Now we have to read about valuation of accounts receivable. Wow. Come on, I keep losing my spot. They literally didn't note who the revered accountant was. The credit manager's idea of heaven probably would be a place where everyone eventually paid his or her debts. Wow, hilarious. Debits to bad debt expense. Uncollectible accounts expense. Yeah, I know. It's kind of weird how, like, all the stuff I'm reading, I learned like 70% of it in financial accounting, and then there's like 30% of extra stuff, which makes it apparently intermediate accounting. And yet I'm still struggling. It doesn't make any sense. Direct write-off and allowance method. Direct write-off. So when they determine to be uncollectible, charges the loss to bad debt expense. So there's $8,000. That's uncollectible. Bad debt expense, debit. Accounts receivable of USADO, $8,000. Direct write-off method records facts, not estimates. Simple and convenient to apply. Theoretically deficient, it usually fails to record expenses in the same period as allocated revenues. It does not result in receivables being stayed at the net amount expected to be collected on balance sheet. So it's not considered appropriate except when the amount uncollectible is immaterial. So the appropriate method is allowance method for uncollectible accounts. Yes, I remember doing that. They basically just estimate how much they will not be able to collect. Estimate uncollectible accounts at the end of each period. Ensures that they state receivables on the balance sheet at the net amount expected to be collected. Three essential features. Estimate uncollectible accounts receivable and compare the new estimate to the current balance. Company's debit estimated increases in uncollectibles. Debit. Okay, just show an example. It's much easier to understand this one. Illustrate this by using an example. They have this many credit sales, $150,000 remains uncollected. Hold on. And then $10,000 of those uncollected sales will be uncollectible. So, bad debt expense is debited, which means increased, and the allowance for doubtful accounts, which is credited, which will be a contra asset. That was funny. The contra asset of allowance for doubtful accounts will be subtracted from, or will be subtracted from what? Accounts receivable. So at the end of the year, they're going to estimate the amount that they won't be able to collect of the uncollected amount. Their accounts receivable is $150,000. They estimate that $10,000 will not be able to be collected. So they will subtract $10,000 by saying less allowance for doubtful accounts on the balance sheet. Well, yeah, but their entry is bad debt expense and allowance for doubtful accounts. That was great. Balance sheet. Bad debt expense is reported in the income statement as an operating expense. Why am I trying to study this concept which I already learned 2 years ago? That's the thing. I learned it 2 years ago. I have to get caught up on this stuff. It really sucks to take a 2-year break. Well, not really. Because I had financial accounting, and then the next semester I had management accounting, and then the next semester I had financial statement analysis, and then the next 2 semesters I did nothing, and then the next semester I did nothing relating to accounting. That was funny. But I'm included summer semesters in that description, so it doesn't make any sense. Hate myself. That was funny. Contra account instead of directly crediting accounts receivable, because they do not know which customers will not pay. The credit balance in the allowance account will absorb the specific write-offs when they occur. They do not close allowance for doubtful accounts at the end of the fiscal year because it's in the balance sheet. Recording the write-off. I keep using this clippy. Like, seriously, it's called a clip. It's called a clip. Okay. So, standard practice to write off accounts that are 210 days past due. So they will write off $1,000 balance owed by Randall Company. So you will debit the allowance for doubtful accounts. So, debit the allowance for doubtful accounts. Oh my gosh. What is allowance? It's confusing because it's a contra asset. I'm so confused. God, I'm trying to logically think through this right now. The contra as the allowance for doubtful accounts. That means it goes from 10,000. It decreases that account from 10,000 to 9,000. It decreases it, and the accounts receivable is credited. That means it's decreased. They both get decreased by 1,000. That was funny. Sometimes they think that it's going to be uncollectible, and then they get the amount. So first they reverse the entry made in writing off the account. They reverse the entry, journalizes the collection in the usual manner. Cash, accounts receivable. So you just do the reverse of this other one. You do the reverse, and then you do the normal thing. In real life. Real life. In real life. Companies must estimate that amount. And they use the allowance method. What do you mean? I thought that the allowance was the estimation, though. I think I've seen this before. What is this? Am I being stupid? Wait. Let's get check. Oh, wait a minute. Yeah, I think I was just hearing the laundry machine, but let me just double check. What? What on earth? Oh. So all I do is basically get this allowance, get it to this amount, get it to this number here. However you need to get it there. That's what it does. Well, I read objective 3.